Good morning and welcome to Managerial Accounting. As we look at our calendar, as we always do first thing in the morning, we'll be finishing, we should, fingers crossed, be finishing the Chapter 26 exercises today. And so those should be submitted for grading by the end of the day today. After our conversation on Tuesday, I did schedule a drop-in review session. I announced that by email on Tuesday. I did have to shift the time a little bit from what we had talked about because I got scheduled into something else at 9 o'clock. So I shifted the time from 8:30 back to 8. So 8 to 9 on Friday morning. You can't come at 8, but you can come at 8:30. You're welcome to do that. Yeah, thanks, Jamie. I did see you unmuted, but didn't hear anything. So I'm glad you can hear us or hear me. So we do have that drop-in review session. Please make sure you sign up in Starfish. And if you're planning to come and there's something that you want to cover that might not already be prepared, if it's not one of the practice exercises or one of the problems already assigned, if there's something else you want to go over, just send me an email, let me know. But I will be there at 8 o'clock and I will just leave Zoom open and hopefully people will join us if you can. As you know, we have our third exam due on Sunday. So some of you I know have already completed that. Some of you may be planning to do it on Sunday, and that's fine too. That exam covers chapters 22 through 25. Don't forget to open your ebook before you start the exam. And if you do have any questions or concerns you want to talk about before then, just let me know. As you know, next week we'll be covering chapter 27. First week of May, we'll be covering chapter 28, which is our final chapter. And then, so our last actual class day with new material will be Cinco de Mayo. And then the 10th is officially a class day. That's day number 30, but we won't be learning anything new. I will be available if anyone has questions, anything you want to go over, but we'll finish the book on the 5th, and you are welcome to pace the rest of the work however you would like. Officially, the problem is due on Tuesday the 10th, and then the last exam on chapters 26, 27, and 28 is due on Friday the 13th because that's the last day of the semester. That's also the last day to submit any outstanding work from earlier in the semester because I need to get grades in. So anything that's not submitted by that Friday, May 13th, will be entered as a 0 in the grade book at that time. Questions, comments, anything you want to talk about related to the remaining schedule for the semester? Okay. Well, then we will jump right into our work for today. So we ended class on Tuesday talking about net present value, how to use the table. I showed you where the tables were in the appendix to the entire book, not just the appendix to the chapter. So Appendix A at the end of the textbook is called interest tables. And you can see in this exercise, we're given just a snip from that interest table. So, so we have here what we need. We have here what we need, but we'll, for other purposes, such as, if you want to do some present value calculations for your own use outside of class, you should know that those tables are there, and the using a business calculator also has the calculation built in, and I showed you where the formulas were so that you could calculate your own factor if you know the interest rate, the number of compounding periods, and so on. So I realized at the end of class on Tuesday that we didn't have time to get through this entire exercise, because we do have 4 separate cash flows, future cash flows that needed to be discounted. So we could have done 1, but we didn't have time to do all 4 before we ran out of class time. So we're going to pick up here. The Getty's company is evaluating the purchase of $150,000 worth of equipment, and it has a 4-year useful life. And so here are the expected cash flows. You'll notice that we have the net income there. And so the methods that we covered for evaluating capital investments last class included the accounting rate of return, and that's where the net income or the operating income would be helpful for that. But for the net present value calculations, what we're looking for is the cash flows, not the accounting income. So we are asked to use a desired rate of return of 15%. We talked about last class how the company would come up with that 15% expected or required rate of return. And so we know that for our purposes, we're never going to have to figure out what that percentage should be, but that's part of the challenge for any company. So as we look at this table, we're going to be using this 15% column because that's the expected or the required minimum rate of return for this project. So we already know the amount to be invested would be $150,000. That's the upfront cost. If we were to simply look at these cash flows and ignore the time value of money, I just want to add those up. So 80,000 the first year, 65,000, 50,000, and 40,000. The total cash flows, cash inflows from the project would be $235,000. So if we ignore the time value of money and we just do that comparison, well, it costs us $150 and it brings in $235. Well, of course we're going to do that because we would more than get our money back. We talked about the payback period method last time, just as a review. So how long would it take to get our money back? This would be $80,000 the first year. By the end of year 2, we would have gotten back $145,000. And so we would need 1/10 of the year, or a month and a half or so of year 3 in order to get our money back. Payback period would be something less than 3 years. Our job here, though, is to take those future cash flows and discount them back to present value. So we start with year 1. I think I had given you the formula, the basic approach that we would use, but I'll put it here on the screen just to remind you. The present value is the future cash flow times the present value interest factor from the table. So that's the generic formula. We also know if it's a series of cash flows that we could change this into the present value of the annuity and use the what I call table 2, the second set of tables from the appendix. These are each single cash flows. Since they are different each year, we have to discount each one back to present value separately, and then we'll add up those totals. So we start with the first year, $80,000 cash flow. And you can see if we look down here in the table, the factor associated with a 15% interest or discount rate and 1 year, 1 period is 0.87. So the idea here is we spend the $150,000 at the beginning of the year so that at the end of the year we bring in $80,000. That $80,000 at the end of the year isn't equivalent to the $80,000 at the beginning of the year. But it's pretty close, somewhat close, because again, we only have to wait 1 year to get that cash flow. And so the value of that first year cash flow would be in present value dollars, $69,600. Everybody okay with where that comes from? So then we go to year 2, it's $65,000. And the factor for 2 years at 15% discount rate is 0.756. Move on to year 3. In year 3, it's only going to bring in $50,000. And the factor for the 3rd year, 0.658. Or 32,900. If you're not already ahead of me, go ahead and do year 4. And then we just need to total all of these. $174,520 is what I got. And everyone else agree with that? So we know it's a total of $235,000 spread out over the 4 years, but when we discount all those future cash flows back to present value using that 15% discount rate, we can see that the present value of this project is $24,520. So how do we interpret this? Well, anything greater than an NPV or net present value, anything greater than 0 is something we would consider. Because we've already built in that minimum desired rate of return of 15%. We've already built that in. So what this is telling us is this project will return $24,520 more than the 15% that we require. So a 0 NPV is really the break-even point on that project where we will bring in exactly the 15%. And anything greater than that is a project that we would consider. So to answer our questions for part B, would management be likely to look with favor on the proposal? Our answer is yes, because the net present value or NPV indicates that the return on the proposal is greater than the desired minimum 15%. Okay, so this is really a review of how to use the present value tables. This table is for a single cash flow. You can tell that because it says present value of $1, but we can also tell, I pointed out to you last class, we can tell because all of the factors are less than 1. And when we get to using the annuity table where we have a regular cash flow, the same cash flow every year for some number of years, then you'll notice that the factors in that table after year 1, all the factors are greater than 1. Get my green check marks in there. Any questions on what we did here? Excuse me. So let's move on then. Looking at exercise 5, then you can see by the title of this exercise, we are dealing with that annuity concept again, where we have a regular cash flow each year for a given number of years. Jones Excavating Company is planning an investment of $125,000 for a bulldozer. The bulldozer is expected to operate for 1,000 hours per year for 5 years. Customers will be charged $90 per hour for bulldozer work. I need to stop for a moment. I should have pointed out in that previous exercise, you'll notice it didn't say anything about a residual value for that equipment. The assumption that we make is if there was a residual value, it's built into this net cash flow for the final year. We wouldn't be ignoring it. Remember, that was one of the disadvantages or the criticisms of, say, the payback period method that we talked about on Tuesday, is we ignore the whole life, part of the life of the asset. Anything happens after the payback, and that includes ignoring the residual value. So using the NPV method, we would include the residual value of this equipment. If there was one, it's included here in this net cash flow. And that should have been made explicit in the exercise, but I did want to point that out. Let's see, where was I? Customers will be charged $90 per hour for bulldozer work. The bulldozer operator costs $30 per hour in wages and benefits. Bulldozer is expected to require annual maintenance costing $7,500 and use fuel expected to cost $15 per hour for the bulldozer operation. So we're asked to do the first determine the equal annual net cash inflows from operating the bulldozer, and then we will find the net present value of this investment. Again, we're not told anything about a residual or a salvage value at the end. So the assumption is that the salvage value or the residual value of the bulldozer at the end of the 5 years would be zero. It's not included anywhere here. So the assumption is it's zero. I don't want you to think that it's just being left out, because it absolutely would be included, would need to be included to have a valid analysis. So even though it doesn't state that, and it should, we'll assume it's zero. So we start with our cash calculation, and this is the first piece of that will be how much cash does it bring in. So customers will be charged $90 per hour, and it's expected to operate for 1,000 hours. So $90 per hour for 1,000 hours will be the cash inflow. So hours of operation per year, 1,000. The revenue per hour, $90. And so our total cash inflows for the year, $90,000. So now our cash outflows. We are given several different cash outflows. We have the annual maintenance, we have the fuel per hour, and we have the labor per hour. And so we're going to have to include each one of those three here. So let's see how it's going to allow us. There is no correct order for these, so we just have to find which spot allows us to put in what we need to put in. So the maintenance cost for the year, $7,500. The fuel cost and the labor cost per hour, those are variable costs. So we can lump those together, $30 for the operator and $15 for the fuel. And we know that it's expected to.
Yeah, that first line is going to be where you have the maintenance. That's going to be the hours of operation.
Really?
Because all the rest of them.
Oh, there's the not. Yeah. I see that. So this. Okay. Thank you. So the maintenance costs normally they only allow you to put in one answer that would make sense. So that makes sense. I see why that is. Okay. Yes, there's the little multiplication symbol there. So we're multiplying the $45 per hour times the 1,000 hours. Thank you. So the total fuel cost for the year, $45 an hour times 1,000 hours, $45,000. Normally, they don't let you put them in the wrong order like that. Excuse me. And so there's our expected annual net cash inflows. We have, didn't say anything about using negatives or positives, right? So, okay. So you may, if it helps you remember, you may want to put negatives there to remind you that those are cash outflows, so we need to subtract those, that it usually in the software it doesn't mark it wrong unless it tells you specifically that you must use negatives. So $37,500 a year for 5 years. Our, oh, there it is. Our desired rate of return is 10%. So remember, we said last class that the longer you have to wait and the higher that discount rate is, the lower the present value of those future cash flows will be. So in this case, we're using 10% as our minimum required rate of return, and these are 5 years of cash flows. So it really is the same formula that I showed you in the last exercise, only now it's the present value of the annuity. And we take the future cash flow, we take the annual cash flow and multiply by the factor from the table. And now I'm sticking the A on the end of that factor, present value interest factor for the annuity. We can tell from this table that it's an annuity because it says present value of an annuity. Sometimes the table might be labeled present value of $1 to be received each period. So you get the idea that it's more than just one cash flow. So we've calculated that the annual cash flow is $37,500. The total cash flows then, if we didn't take into account the time value of money, $37,500 a year for 5 years would be $187,500. And so again, at that point, if we ignore the time value of money, we'd say, yeah, this is a good project. We get back more than we put into it, but we need to take into account that, yes, but those cash flows are spread out over 5 years. So 10% and 5 years or 5 compounding periods. So rather than being worth in today's dollars the full $187,500, it would be worth just $142,162.50. Does tell us to round to the nearest dollar. So I'll round that up to 142,163. Compare that with the upfront investment, which was 125,000. And we find a net present value of $17,162. Again, anything that is positive is something we would consider, something we would be interested in pursuing because it returns the 10% plus an additional $17,162. So should Jones invest in the bulldozer based on this analysis? Yes. Which one should be a 2, Seth?
The last digit in the net present value.
It should be a 2 because we had to round. Is that-
Okay.
yeah. So. Oh, yeah. Yeah, yeah, I think if that's what you were trying to say, Seth, yeah, so I was rounding in my head both of them. So if we just take the number I put in there and then subtract, yes, it would be 17,163. Yep, you are right, both of you, if that's what you were trying to say, Seth, thank you.
No problem.
So yes, because the bulldozer cost is more than the present value of the cash flows, whoops, the cost is less than the present value of the cash flows at the minimum desired rate of return of 10%. The last question we have here is one of a sensitivity analysis. So how close do we have to be? How sure do we have to be that this bulldozer is going to be run for 1,000 hours a year? So what if it's not run for 1,000 hours? At what point would we break even? Or at what point would we say, yeah, we don't want to do that because it's not a worthwhile investment for us? And so what we're really doing is going back to our initial formula and deciding what this cash flow there we go. So this is the cash flow that we had identified based on the information that was given, based on the 1,000 hours. But at what point, at what cash flow would this number be exactly the cost of the project? So let me, oops. So let's do a calculation here where I'm going to just use X for our unknown. X times same factor because it's still the 10%, still the 5 years for the project. So what would the cash flow need to be exactly the 125,000 that the project costs us up front? So if we divide both sides, oops, by 3.791, at an annual cash flow of $32,793, would be the break-even point. Let me clear some of this so it's not blocking our view. So now as we look at this cash flow analysis, we want to know what is the point where our annual net cash inflows would be 32,973. I'm a little concerned about this because I have a feeling the rounding is going to come back to be a bit of an issue for us. But I'm going to change what we have here into a formula just like we had for the flexible budget concept. I don't have a lot of room to put this. Let me get that out of the way. So I'll use a color that's going to stand out a little bit, maybe green. So we're trying to find the number of hours. So I'm just going to use hours as our variable. So, and the revenue per hour is $90. Then we have the variable expense of $45 per hour, and the fixed maintenance costs of $7,500. And we want that to equal, we want to know at what point is that equal to the cash flow that's required for us to break even. Does everyone follow what we're doing so far? And you know that this is one of the things that if you're not friendly with algebra, this is going to be a little bit of a challenge for you, and that's okay. You're not going to be asked to do anything like this on the exam, but hopefully you're able to follow what we're doing here. So $90 per hour minus $45 per hour. The contribution margin is $45 per hour. After we cover the variable costs, we have $45 per hour left And then to make this a little simpler, I'm going to subtract the 7,500 from each side right now to combine these steps. Excuse me.
You want to add it both sides?
Yes, thank you. Good grief. Add it to both sides. My bad. It's a negative in the first place. Apparently my math head is not with me today. Here we go. 40,473. So what I did was combine the like terms. So $90 per hour minus $45 per hour is the $45 per hour times hours. And then I added this 7,500 to each side to get the variable on one side, the constant on the other side. Now we can divide each side by $45. And so what I found was the number of hours is 899.4. As I said, I was concerned that this would be a rounding issue the way I went about this. I am just going to tell you then, excuse me, I'm just going to tell you that the textbook answer, the answer that you need to put in to get credit for this is 903 hours. And the reason it's different is because of the rounding of, if I can, this number right here, the factor that we use, 3.791, is rounded. So it should have more digits on the more decimal places. And so that caused a bit of a rounding issue because of the way I approached this. I don't want people to get too worked up about this particular part of the exercise, although from a business standpoint, it's an important concept to recognize, well, what if we don't actually sell 1,000 hours of this bulldozer time each year? At what point would we start to lose money on this project? That is an important consideration, but it's not, whoops. But because of the rounding issue, it's not as crystal clear in this exercise. And probably had I read all of the instructions, I have a bad habit of that. Whoops. Get this back up there. So I see now, because I didn't pay any attention, it says to round interim calculations to the nearest whole number. So that also would have affected our calculations. Does anyone have any questions though about what we just did here? And
I was wondering, kind of the biggest difference between 4 and 5. In exercise 4, we took it per each year. We took the value and used that.
Mhm.
But then in this, we just used the value for the 5th year. Is that,
well, it's not the value for the 5th year, it's the value every year for each of the 5 years.
okay.
So this analysis is the annual cash flows. So
Mhm.
each year we expect to sell 1,000 hours of bulldozer time. And this is, so our revenues would be 90,000 and our costs would be 52,500. So our annual cash flows. So this is 37,500 a year for each year. Does that make sense?
Kind
Or did I misunderstand what you were saying?
of misunderstanding. In question 4,
Yeah.
we took the value per year and then we multiplied it by each year on the table. In
So are you-
question 5, we took the value per year, but we just multiplied it by the year 5 value on the table.
So it's year 5 means because this is the table for the annuity,
Mhm.
it's this year 5 value of 3,791 is
For
the combination
5
of 1 through 5. So but to answer maybe what you were wondering, if we were to take the 37,500 and multiply it by this one, and then this one, and then this one, sorry, we'd have to use the table in 4. If we were to take the 37,500, use the table for a single cash flow and multiply by this, we'd find the first year value. Then multiply by this, we'd get the second year, this third, this fourth, this fifth, and then add all those up, just like we did in exercise 4. We'd get a number that was very close, but a little bit different because of rounding.
Okay.
Because these factors are rounded. So, this table that we used in exercise 5 really takes out some of the work, a lot of the work for us, because we can use just one calculation as long as the cash flow is the same every year. We couldn't do it in exercise 4 because each year had a different cash flow.
Oh, okay.
But as long as you have identical expected cash flows each year, you can use the annuity table.
Okay,
Does that make sense?
yeah, so that was the biggest difference between the two.
Yes, that the cash flow wasn't expected to be the same each year. Yep. So other than the rounding issue, which I knew we were going to encounter, any questions, any other questions related to this exercise? Okay. In our next exercise, we're going to use the NPV method again, but we're also going to encounter present value index. So I want to go to the PowerPoint and just talk about what that means before we go to exercise 6. So we've been looking at the net present value method in these first 2 exercises we've done today. We know that what we're doing is taking any cash flows that happen in the future and discounting them back to present value. So we're recognizing what we talked about last class, that if you're given a choice, $1 today or $1 even next week, you're going to choose the $1 today. And this gives us a mathematical or an objective way of building that time preference into the calculation, into our analysis. We've talked about where that interest rate or that discount rate, the minimum required rate of return, where that comes from. We know for our class, we're not going to be able to predict that number or set that number for ourselves. So that's always going to be provided for us. But in a real world setting, that's up to the company to decide, and there's no wrong answer. And that number, that discount rate or interest rate, is likely to change as conditions change. So it could be 15% one year and 20% the next year. Excuse me. So advantages and disadvantages. We've been talking about these for each one of the methods that we have looked at so far. So advantages of the NPV method, we've already really talked about these. It considers cash flows, not that accounting rate of return, accounting income, considers the time value of money. This exercise 6 that we're going to look at next allows us to calculate an index, so we can compare projects of different cost or different upfront cost more readily by using that index. Disadvantages, it's a little bit more complicated. And it also assumes, we have to assume or figure what that minimum rate of return would be. And we may be wrong about that. It may be that we use the wrong percentage, the wrong discount factor. As I said, whoops, why did that stop? There we go. As I said, our next exercise uses the present value index. So you may want to take a note of this calculation. The present value index is found by taking the total present value. So we still do the same steps we did in exercise 4, exercise 5 to find that net present value. And then we divide that by the upfront investment. And so we haven't seen an exercise where the NPV was negative. You can imagine, because we've kind of alluded to this, if the NPV is negative, that's not a project the company should consider in the first place, because it will lose them money. It's not a winner for the company. But if you think about those last two exercises, let's say those were the same company in exercise 4 and exercise 5, they both had positive NPVs. So how would we know which of these projects, if we could only fund one, how would we know which one is the best one? And this index gives us a way of standardizing that. Remember, an index is really a percent without the percent sign. And so the index gives us a way of comparing two projects that maybe have different lengths, different number of years, and also different upfront investments. So hopefully you've made a note of that, and we can go to our exercise now. I can find it. Here we are. And so we'll be able to compare these two machines for this project. Diamond and Turf Incorporated is considering an investment in one of two machines. The sewing machine will increase productivity from sewing 150 baseballs per hour to sewing 290 per hour. So when we think about that marginal or incremental analysis, we get an extra 140 baseballs per hour. The contribution margin per unit is 32 cents per baseball. Assume that any increased production of baseballs can be sold. So we've talked about that concept many times at this point. The idea of pull-through production, we produce it because we can sell it, not because the machine has some excess capacity. The second machine is an automatic packing machine for the golf ball line. The packing machine will reduce packing labor cost. The labor cost saved is equivalent to $21 per hour. The sewing machine will cost $260,000, have an 8-year life, and will operate for $1,800 per hour. Packing machine will cost $85,000, have an 8-year life, and will operate for 1,400 hours per year. Diamond and Turf seeks a minimum rate of return of 15% on its investments. So from what we've just read, it sounds as if the company is not able to invest in both of these, or not at this time. And so it has to make a decision of these two projects, which one should we undertake? So the first thing we're going to do is find the NPV of each project. And if we found that one of them had a negative NPV, we would already know the answer. Not something we should consider. Let's do the positive one. If they're both negative, we shouldn't do either one. But if we find that they're both positive, given that they both have such different upfront costs, the investment $260 for the sewing machine and only $85,000 for the packing machine, we can't just compare the dollar amounts of the NPV and say, yeah, that's the better project, because the upfront investment is more than 3 times as much for the sewing machine as the packing machine. And so if we find that they both have a positive NPV, then we'll go to the present value index to see which one is the better overall project for us. But the first thing we have to do, excuse me. Excuse me. The first thing we have to do is calculate what the cash flows are for each of these projects. And so we'll start with that. I'm going to use my white space over here. I can make sure I'm showing everything I need. We'll use our white space over here to do those calculations. So this is going to be an annuity question. We already knew that because it's in the title of the question, but we also know that because it tells us that the information is the same for each year. So we'll start with the sewing machine. We're looking at, remember that differential or incremental analysis, we would go from sewing 150 to 290 baseballs per hour. So the increase would be 140 baseballs per hour at 32 cents in contribution margin. So that's what's left of the selling price after we cover the variable cost. And it tells us that the sewing machine will operate for 1,800 hours per year. So 1,800 hours producing 140 baseballs, additional baseballs per hour. And each of those baseballs contributes, each of those baseballs contributes 32 cents to the bottom line. So if I did the math correctly, that would be, excuse me, $80,640 per year in extra contribution margin contributed by the sewing machine. Everyone okay with that calculation? So how about the packing machine? Let's see, what does it tell us about the packing machine? The packing machine is going to save us $21 per hour. So no change to revenues, but by lowering our expenses, we will increase our contribution margin by $21 per hour. And it will operate for 1,400 hours per year. And so the packing machine will contribute an additional $29,400 per year. Each of these is an 8-year life on the project, and we're told to seek a minimum 15% rate of return. So 15%, 8-year life. Here's our factor, 4.487. So we can now find the present value of those future cash flows by multiplying the cash flow, the annual net cash inflow, by that factor. So for the sewing machine, $80,640 times 4.487. And round to the nearest dollar. And for the packing machine, $29,400 times 4.487. Round to the nearest dollar. Everybody agree with those numbers? Apparently you need to check my math today. So the sewing machine will cost $260, the packing machine would cost $85. So we can now find the net present value of each of those projects. And so we can see that each of the projects has a positive NPV. So if the company had the money available, we would suggest you should consider both of these projects. But if we don't have the money available to cover both of them, how do we know which one is the better project? Well, the initial temptation is to say, well, clearly it's the sewing machine because the sewing machine has the higher NPV. Yes, but it also has a much larger upfront contribution, or excuse me, investment. And so this is where we're going to use that NPV index, or excuse me, the present value index. And I showed you the formula. I asked you to make a note of it. The formula is we take the NPV and divide by the upfront investment. Whoops. I think I said that wrong. I think I said NPV. I want to take the present value. As soon as I looked at my index, I knew that wasn't correct. So take the present value and divide by the amount to be invested. 1.39. That is more like it. So if the present value index was less than 1, that would mean, it's how, when I looked at the number on my calculator, I said, no, that's not correct. If the present value was less than 1, it would mean the cash flows discounted back to present value didn't cover the investment. So I knew that I had punched the numbers wrong into my calculator and said the wrong thing. So let's go to the packing machine. And round to the two decimal places, we are told. So as I suggested, if we had money, we should consider funding both of these projects because both have a positive NPV. But if we could only invest in one, our better investment would be the packing machine because we get a higher rate of return. In other words, the cash flows, if we look at this index, the cash flows discounted back to present value are 55% higher than the upfront cost. Where for the sewing machine, they're only 39% higher. Still a really good return on investment. But if we can only fund one, we want to fund the one that has the better rate of return.
In a situation like this, though, where, I mean, well, for the biggest difference for me is the fact that the one is 260 and the other is 85.
Okay.
And the 260 is pulling in, 80,000 a year, we're assuming in revenue, not counting whatever we pay for it. So it seems like we would be getting the value of the packing machine quicker by buying the sewing machine first than if we bought the packing machine first to save up the value for the sewing machine.
Okay, so if you're, again, I never know if people on Zoom can hear what's being said in the classroom. So to summarize what I think Drew is saying is, if the goal is to buy one and then use the proceeds, the profit from that one to then be able to buy the other one.
Or at least have both at some point.
Yeah, so that's valid. If you're thinking that the $80,000, $86.40, I think $80,640, I think was the number. If that's how much you're bringing in from the sewing machine, those net operating income would quickly allow you to pay for the packing machine. And you could look at it that way. As I said, either one of these is a very good return on investment. And so this is just one way to look at it. And you'll notice it says qualitative factors are equal between the two. So which one fits in better with your long-term plans? But if your goal really is, as you just suggested, to maybe use the profits from one to be able to purchase the other, to turn around and reinvest those funds, that's another way of looking at it. And that would be one of these qualitative factors. So it's not wrong.
With the premise of the question, it seems like they would want both machines. If they're looking at both machines to invest in. So it seems like if the goal is to have both machines at some point, it seems like buying the sewing machine first would help set up a better situation to eventually have both.
That could be. Yep, that definitely could be, because the net cash inflows clearly are higher for the sewing machine. The dollar that of the net present value is higher. So yes, if your intent was to buy both, I mean, if you want to look at it this way, if we say that this 15% return covers the cost of maybe having to borrow that money, maybe they should see if they can invest in both. But the question says if they can't get both. And so we have to go with the assumption that they have to choose just one, and those factors that you just mentioned, like we want to have both eventually, which one will get us there faster? You know, we're basically told to disregard that. So that's what they mean with this part of the question. But yeah, that's not an incorrect or inappropriate way to think about this. If the goal is to get both, ideally, they'd get both right now because they can see that both are good investments. But in letter C, we're told, yeah, but we can't. What if we can't? And we're going to disregard everything but which one is the better return on investment. Okay. Any other questions before we keep going? Okay. Exercise 7 then is going to have us contrast the 3 methods that we have covered so far: average or accounting rate of return, cash payback period, and net present value. So since we have covered all of these methods, this will be a good review. I'm going to pause the recording and ask you to work on this on your own for the next couple minutes. And then we can restart the recording and answer any questions. And I'm going to do mine on my screen while the recording is paused. Okay, so looking at these 3 methods that we've done so far, starting with the average rate of return, we first had to find the income from the project. That's the accounting income. So we have the cash flows, but then we needed to subtract the depreciation. So the depreciation, we were told to assume straight line depreciation, no residual value. So we take that full upfront or historical cost and divide by the useful life of 8 years. And so we find the annual accounting income would be expected to be $156,250. We then divide that by the average value of the investment. So we start with the upfront cost, add to that the residual value, and divide by 2. So that gives us the average value of the investment over its 8-year useful life. And so 156,250 divided by that number, which is 625,000, would give us 0.25 or 25%. For the payback period method, we take the original cost, and since it's the same cash flow each year, we can simply divide rather than having to subtract each year as we saw last class. So we take the upfront cost, divide by the annual cash inflows, and we find a payback period of 4 years to get our money back. And then for the NPV, we take the cash flow multiplied by the factor from the table. So the required rate of return and 8 years, so the factor is 4.968. That gives us a present value of those future cash flows of $1,552,500. Compare that to the amount to be invested, and we get a net present value of $302,500. Would a company use all 3 methods? As highly unlikely. Keep in mind, for each one of these 3 methods, it is part of the process is you decide in advance what's going to be acceptable. So for the annual, for the accounting rate of return or the average rate of return method, we decide in advance what percentage is an acceptable accounting rate of return. For the cash payback period, we decide in advance how long is the maximum amount of time we're willing to wait to get our money back. For the NPV method, it's implicit in the calculation. We've already decided the minimum rate of return is whatever we use for the discount rate. So in this exercise, we're already told it's 12%. We were not told for this exercise what's the minimum average rate of return, what's the cash payback period that's acceptable. But in a real world situation, if we're using either one of those approaches, it's not okay to calculate the number and then say, is that good enough? We really need to set that hurdle rate up front. So that was a good review of all three methods that we've covered so far. We have one more method to go. Any questions on what we've done up to this point? All right. Then we'll keep going. Go back to our PowerPoint to cover the fourth and final method of capital investment analysis that's covered in our chapter, and that is the internal rate of return. So the internal rate of return is kind of the flip side of the net present value method. It uses those present value concepts that we have just been covering. So we remove some of the disadvantages of the first two methods, the accounting rate of return and the cash pay or the payback period method, because we are taking into account the time value of money. But as I said, this is kind of the flip side, kind of the inverse of the net present value method, where we set a percentage up front and then we calculate. We kind of do the opposite. We look at the cash flows and we work backward to find what the percentage would be. So we're going to kind of triangulate on that table to find out what the percentage, or what the discount rate, the applicable percentage rate of return would be. I think it's probably going to be easier for us, rather than reading through and making note of these formulas, if we just go to our exercise and work through the exercise. I think that will be simpler for us to see what's happening. But you may want to, on your own, take a look at the PowerPoint. Remember, you do have access to those on the textbook companion website. And this formula, these steps are also in your textbook. Before we do that, though, let's look at the advantages and disadvantages of this approach. So it does consider cash flows. It does consider time value of money. It does allow us to rank proposals, even if the proposals are not of the same length of time. So we could have a 4-year project, a 6-year project, and it becomes more challenging when we're looking at something like the payback period method. Disadvantage, it is complex, just like the net present value approach. And just like the net present value approach, it assumes that the percentage is valid. That if we come up with that rate of return percentage, that it is that it kind of, I guess this is a good way of thinking about it, that it stays stable. So we set that percentage now, but is that really going to be the same percent next year or the following year? Is that still going to work for us? And we already said that percentage, that required rate of return, is going to change over time. So we make a decision based on conditions right now, and then they change. So what do we do with that? But let's go to our exercise. Exercise 8. The internal rate of return method is used by Testerman Construction Company in analyzing a capital expenditure proposal. That proposal involves an investment of $113,550 And we expect it to bring in annual net cash flows of $30,000 for each of the 6 years of its useful life. So I want to remind you of the formula that I had put on the screen in exercise 5, present value. So this is going to be an annuity because it's the same cash flows every year for the 6-year useful life. So this is the formula I had given you in exercise 5. Oops, there we go. And so what we're doing in the internal rate of return method is really flipping this formula. We are not going to look up the present value interest factor because we don't set a percentage in advance. So we can't use the table to look up what that factor should be. Instead, if I can just solve this formula, the present value interest factor, I'm going to divide each side by that future cash flow. So it's the present value divided by the future annual cash flow. So I've just taken that formula we already used, and instead of solving for the present value, we're going to solve for the factor, and then we're going to find that factor or as close as we can get in the table. Okay, so how do we make this work? The present value, what we're trying to do is find what future cash flows would be equivalent to the upfront investment. So if we set the present value to be that the investment amount, $113,550 in this exercise, and then we divide by the annual cash flow of $30,000. And you have to know how to use your calculator. There we go. I got 3.785. Everyone see where that number came from? It's the upfront investment divided by the annual cash flow, because this is an annuity exercise. And we're told that this is a 6-year useful life project. So this is the row that I'm interested in. The row that corresponds with 6 years. And I'm looking for, in that row of 6-year project, the percentage that comes closest to the 3.785. Now they've made it very simple for us because that number appears exactly, that's obviously contrived. They made this work out. It is highly likely that we would actually have to interpolate or find a point between 2 points. But you know, our textbook examples are frequently very nice and neat and tidy. So what this tells us is that if our $113,550 investment gives us $30,000 in cash flows each year, that would equate to a 15% return. And so if we look down here to what we're asked for in this exercise, determine the present value factor, and we did that, it would be 3.785. And then we go to the table and find the corresponding internal rate of return would be 15%. Right there. 3.785 equates to a 15% return for a 6-year life project. Everybody okay with what we just did? Okay, we just switched out the formula. We didn't set the percentage in advance. We figured out what that percentage would be. my concern with this approach, the internal rate of return, is just like I said for the other methods, it is really important to decide up front what's an acceptable rate of return. And then this comparison becomes very simple. What did we say was the acceptable rate of return? In this exercise, we weren't told that. But if we are this company, Testerman Construction Company, we better have a number in mind up front. And if it's 12%, we would look at this project and say, that's great. If we set the percentage at 16%, we look at this project and say, not good enough. But we need to have something to compare, to make that decision. I referred to it a couple times now as the hurdle rate. We need to have a number in mind up front to compare to these projects. But you can see why using the internal rate of return, assuming we have that hurdle rate in advance, would allow us to better compare projects of different size, different scope, different length, because for all of the projects that we analyze using this approach, we come up with that number, and then we, that percentage, just like the present value index was easy to compare, projects of different size, those projects were the same length, but they could have been different lengths. And we could have used the same approach. Questions about that? How to use the internal rate of return? Okay, so let me, I'm going to skip over exercise 9 just for a moment so we can go to the final exercise. Exercise 9 is another example of internal rate of return. So I want you to do that, but it is not new information. It will be another practice for you. So I want to move ahead to exercise 10. And because this is different than what we have done up to this point. So let's look at exercise 10, and then once we finish this, I will ask you to try exercise 9 on your own. You can either stay and do it, and we can go over it, or if people just want to do it on your own and let me know if you have questions, that's okay too. So exercise 10. I don't think I have anything I wanted to talk about from the PowerPoint. Let me just make sure. There we go. Yeah, I think we can just do this from the exercise itself. Okay. Bunker Hill Mining Company has 2 competing proposals: a processing mill and an electric shovel. Both pieces of equipment have an initial investment of $750,000. The net cash flows estimated from the 2 proposals are as follows. So you can see that if we buy the processing mill, we expect to use it for 8 years. And if we buy the electric shovel, we expect to use it for only 4 years. We have unequal cash flows each year. So we know we're going to have to discount each one of the cash flows back to present value independently. And so the table that we have we are given here is what I refer to as table 1. It's the single cash flow table. We can tell that because all of the factors are less than 1. And so in order to compare these 2 projects that are of unequal lengths, we're going to kind of cut them off. I can get I'm going to kind of cut things off here at year 4 and say, well, let's compare at the end of year 4. And so we have the residual value of the processing mill at the end of year 4, and we can do the comparison based on just what would happen through the first 4 years. So we'll start with the processing mill. gonna erase that line so I can scroll down a little bit. So we'll start with the processing mill because that's the one that's listed here first. We can put in our amount invested, $750,000. And then, well, let's go to the processing mill. Again, we're just going to look at the first 4 years, and then for the sake of this discussion, we will assume that the processing mill is sold at the end of 4 years for the $280,000. And I need, whoops, I need to scroll down a little bit more. I need 4 years worth of that table. Okay. So we're doing the processing mill first. And we start with year 1. We have cash flows of $310,000. And now I don't know what the percentage was. What did that? I can't scroll because I've got my 15%. So it tells us to use a required rate of return of 15%. So the factor for 15% in 1 year is 0.87. And we're just going to do this for each of the first 4 years. Remember, for the processing mill, even though if we did the project, we could have it go for another 4 years. In order to make these comparable, we are going to consider that at the end of the 4th year, the residual value of the processing mill is $280,000. And we'll say, what if we sold it at that point? Again, to make these comparable for the same number of years. So we're still using that same 4-year factor. This cash flow would happen at the end of the 4th year when we could sell the machine. It doesn't mean we would have to. It doesn't mean that we can't make this project go 8 years. We're just doing this for the sake of comparing the 2 projects. So then I just need to add those 4 annual cash flows plus the residual value, present value. I got $946,220 is the present value of the future cash flows associated with the processing mill. Whoops. Scroll the wrong one. So we can compare that. To the upfront cost. And we find a net present value of $196,220 for the processing mill. Everybody agree with that? So now we can go through the same thing for the electric shovel. Discount the only 4 year's cash flow that we have for the electric shovel because it's a 4-year project. And the assumption, because it doesn't tell us anything about the residual value of the electric shovel. Again, I wish they had made that explicit. We're going to assume there is no residual value or that it's included in this $320,000 cash flow at the end of year 4. I wish they would say that, but that is the assumption we are making. Either it's 0 or it's already included in that year 4 cash flow. So go ahead and do those calculations for the electric shovel. Once again. Any questions about that calculation? So why is it that in this exercise, they don't ask us to calculate the index in order to do the comparison? Why do they not ask for the index to compare these two projects? Why is it okay for us to just look at the net present value in dollars, not as an index?
Because it will cost us.
Exactly, because the upfront investment is the same. And so when we look at 196,000 versus 180,000, we really are comparing apples to apples because the upfront cost was the same. And so we can make a determination about which of these projects we would suggest or which should be favored. Yep, Seth, for the electric shovel.
No, for the processing.
Oh, shoot, I already erased those. Yep, so let me just explain where it came from. Hopefully, and if I need to, I can rewrite it on the screen. But I took each one of these, the first 4 years. So we're trying to compare a 4-year project to an 8-year project. And the way we are doing that is by pretending that the processing mill would only be a 4-year project. So we drew that line across. And so I took each one of the first 4-year cash flows and multiplied by the relevant percentage from the 15% column. But then, because the processing mill still had value to us at the end of year 4, we took this, the $280,000 residual value, and at year 4 and multiplied by the year 4 factor and included that. So our calculation for the processing mill had the first 4-year, just like we have here, but then it had another calculation of, for the residual value multiplied by the factor for the end of year 4. And that's where the 946,220 came from. Does that make sense? Can you see where maybe you were missing something?
Yeah,
Excuse me. Okay. And so again, that allowed us to compare projects of 2 different lengths and make an informed decision. Either one of these projects meets the minimum rate of return. So we're assuming, again, that this company is not able to do both, that it's choosing one or the other. And so we can give them an informed decision that both projects return more than the minimum 15%. Both of them have a positive NPV. But if you have to choose one or the other, you should go with the processing mill because it has a higher NPV. We should not be considering any projects that don't have a positive NPV. The NPV is less than 0, negative, or if the present value index is less than 1, then that's a project we would not want to consider. So I'm going to stop here. We have about 6 minutes left in class. As I said, I am asking you to do exercise 9 on your own, that if you want to stay and do that now, but independently, you're welcome to do that, and I'll be happy to answer any questions. If you choose to do it on your own later, you can let me know if you have any questions, or we could answer any questions about this on Tuesday in our next class. All right. Any questions before I stop the recording? Well, if you haven't taken the exam yet, good luck on that this weekend. If you do want to come to the drop-in review session tomorrow morning, please make sure you sign up so I know to expect you. If nobody is signed up, I will assume that nobody is planning to come. All right. Thank you.